Okay, welcome back. Aaron Ninness from Denver, Colorado, your mortgage professional. Another episode of How Much Can I Afford? Today's topic is income, what you use to repay your loan. When it comes to income, how it gets calculated is pretty complex. So I am just going to address real quick some items for thinking about as you start applying for a loan or going on your home search. So first off, when it comes to income, a good rule of thumb is a 2-year history. Now, 2-year history is in reference to how long have you been doing this business. As an example, if you were in, let's say, a vet clinic, you were just working as a vet tech, and then all of a sudden you decided your calling was being a car salesman. That's great. However, you really need a 2-year history of employment, which you may have if you worked at the vet clinic long enough, but then you come into a 2-year question based on what type of income. In the world of incomes, we have different types of income that we need to address, right? So we have hourly, salary, commission, bonus, tip, all kinds of different things like that. When we talk about hourly or salary, if you are a full-time employee, which is usually a 40-hour employee unless you're someone like a nurse, an RN, an LPN, where 36 hours is a very standard full work week, we're going to take your hourly wage, we're going to multiply it in, and that's the income that you're going to be using as a gross income. Where you start to get variances is where someone was hourly and they've worked at the same company for 3 years, and they started at $20 an hour, and then they went to $22 an hour, and then $24. When an underwriter starts to go through your income, they're using a couple key pieces of data to figure out if your income is stable. And that's the big question: stable, predictable income. All right. So they take your W-2s, they take your pay stubs, and they look at those to see, based on your 24-hour or $24 per hour wage, is that similar to what you have for a W-2 in 2016? Well, no. If that raise was, let's say, February of this year, 2017, your 2016 W-2 isn't going to reflect that wage. So you start to get into a scenario where they may have to do some averaging or reach out to your employer and find out the exact dates of when those raises went into effect. Now, conversely, when we get into commission, tip income, bonus income, or overtime, that is something that is less stable. Commission by nature is what you have earned through, a lot of times, sales. Bonuses, same thing there. Most companies will not say commission or bonus is guaranteed. They are open to how good of a job you're really doing. So under that idea, it's necessary typically to have a 2-year history. Now, there are some circumstances where going down to 1 year is okay, but it should always be assumed that you need a 2-year history on those types of incomes. And that does include self-employed income because, again, you are a master of your own destiny in that scenario. What we'll do is simply take an average of income for each type and divide it by however many months. Here's an example. Let's say that you started in January of 2015 as a car salesman. As a car salesman, you earned your commission in 15, you earned your commission in 16, and now we're into 2017. Chances are that I'm going to get income history from your employer on how much commission you earned in 2015, 2016, and your year to date for this year. We'll combine all those, and then we would go ahead and divide it by however many months, 24 for the first 2 years, and then if this were July or August, let's say, that would be another 7 or 8 months. In that scenario, you would be taking the lump sum divided by 32 months, voila. That's your qualifying income on just that type. When those are all combined together, that's how we get the gross income that you qualify with. Now, here's how it works. Other episodes talk about the debt to income ratio. This is the other half of that. The first half is how much you have in outgoing liabilities, and that's divided into your gross income. But gross income should actually be called gross qualifying income because it's only the income that an underwriter can use to get you qualified that we're going to look at. Let's say, for example, that same car salesman had a salary of $4,000 a month, and then he had commission on top of it. In a scenario like that, we don't have a 2-year history of him earning commission, but his salary is something that is stable and predictable. So it makes sense for us to say we can use the $4,000, but until a 2-year history was there, we couldn't use the commission. That may be a scenario where maybe someone started a job in January of 2017, the year that I'm filming this, and Now it's August. In between January and August, they've had good commissions, but because they don't have a 2-year history, we can't use that. But their salary has been paid the entire time. We'll absolutely be able to use that salary for going forward. Most important thing you can do is when you start to think about buying a home, get with a lender and have them look at your income. Most people do have pretty easy, predictable, and stable income to use. A lot of folks out there are salary, hourly, or something that, paid biweekly, whatever the case is, where it's easy to calculate how they're paid. But for those who have more tricky scenarios, commission, tips, overtime that you know is going to be used into your qualifying or that you really need to rely on to get the house that you're looking for, you need to have all your ducks in a row before you start looking at properties. It takes only a couple minutes for you to get that worked out, but you need to know what documents are necessary. In general, you're going to be asked for 30 days of pay stubs, 2 years of tax returns, and 2 years of W-2s or 1099s. If you're self-employed, you'll definitely want all those, including any business returns if you have a partnership or an LLC. That should give you plenty of details that you can hand off to your mortgage professional, and they can give you an idea of what income they're using. Do also keep in mind, if you don't think you're getting a good amount for your income, get a second opinion. Not all lenders will calculate this the same way. There are variances between companies, so sometimes you might find that different incomes can be used by different folks. As always, my job is to help you with this exact stuff. So if you're looking for someone to help you figure out how to get a home, how to get through this financing, I might be a perfect scenario. Give me a call, shoot me an email. I'd love to help. Otherwise, keep watching the videos. Make sure you subscribe, give me a like, and then we'll see you on the next one.